Today, household financial confidence is crushed some more. Hello again, it's Martin North from Digital Finance Analytics, welcome to the latest post covering finance and problem news with a distinctively Australian flavour. In our latest release to September 2019, the DFA Household Financial Confidence Index fell again, having moved sideways more recently. Households are simply reflecting that rate cuts, a lower dollar, and the international bad news from Trump's trade wars, Brexit, and Hong Kong are all making them more concerned and less willing or able to spend. On top of that, the local pressure on wages and rising costs, plus the heavy toll on savers with funds on bank deposits, are also hitting. Finally, property is not in recovery mode, and buying intentions are down again after being a little higher after the election. So the economy, we think, is in deep trouble. And the government and regulatory response is just not cutting the mustard from a household and small business perspective. Overall, the index fell to a new low of 84.2, compared with 85.5 last time, and this is a significant one-month fall. All wealth segments faded, but those holding property without mortgage and with market investments like stocks and shares did a little better than those with a mortgage and those renting. All three segments are below their 100 neutral setting. Across the property segments, those owner-occupied households with a mortgage are relatively more positive compared with property investors who continue to see their rental streams under pressure, and now even those renting or living with friends or family are also reacting to the cost of living rising and flat incomes. And we also registered a number who say landlords recently lifted their rental agreements, which added to their pain. Across the states, the falls are relatively uniform, with the confidence levels bunching at low values in the eastern states. Falls in South Australia and Queensland were offset by a slight rise in Western Australia, but New South Wales and Victoria both fell. Across the age bands, those aged 50 to 60 registered a significant decline as falling income from bank deposits hit home following the recent cash rate cuts. All other segments fell too, so this is a broad-based decline. Turning to the moving parts, household income remains under pressure, with little evidence of any recovery in the system. More than half have real incomes lower than a year ago. The costs of living continue to rise, and recent petrol prices are making an impact, along with council rates and childcare costs. Food bills are also rising, and here the impact of the drought is hitting some costs hard now. 92% of households reported a rise in living costs, compared with just 1 year ago. Savings are also under pressure, as many households continue to tap into their savings to support their lifestyles, but those with savings in bank deposits continue to see rates fall, meaning that incomes from deposits are being crushed. That said, of the 3 million relying on income from savings, less than 1/3 are considering seeking out higher risk saving options to boost returns. The rest are moderating their spending patterns to suit the new low-rate environment. However, there are limits to this approach as rates continue to tumble. And those on fixed-term rates are facing a real challenge when their funds are due to roll next. Rate cuts have helped at the margin, but there was also a further rise in those feeling less comfortable about their level of debt. We see a rising concern about making monthly repayments on time, but also an issue with paying off debt in due course, given that home price growth is anemic at best. Many continue to pay down credit card debt, although a minority continue to accumulate more debt in order to balance their budgets. Employment prospects are under pressure, and the retail and construction sectors in particular across all states. There was a 1% fall in those feeling more comfortable to 8.6%. But there was a marked fall in New South Wales and Victoria, and their residential construction has stalled. Employment prospects are brighter in the public sector, so Canberra is showing more positive news here. Finally, net worth has taken a hit again as property values are not rising for many and the evidence of negative equity is growing. The oft-quoted recent rises in Sydney and Melbourne clearly do not tell the full story, and property investors with units across the country are becoming increasingly nervous about the true value of their property in the light of the poor quality construction and certification issues that are rife in the sector. So there is little here to offset the gloom. Whilst lower cash rates may translate to lower mortgage rates for some, this is not sufficient to counter the negative news, and more households are seeking to pay down debt in an attempt to protect themselves in the months ahead. All of this signals more economic weakness ahead. And to validate our findings, according to an ANZ survey, consumer confidence slumped to its lowest level in more than 2 years at the weekend. And that suggests people are preparing for more difficult economic conditions over the next 5 years. The ANZ Roy Morgan Australian Consumer Confidence Index fell 3.5% from the previous week, with respondents' perception of the economy, including the outlook for the next 12 months, dropping 0.6%, and sentiment about conditions during the next 5 years plummeted 7.6%. The weekly measure of consumer mood, which is based on about 1,000 face-to-face interviews conducted on Saturday and Sundays, also recorded a 4.6% drop in how people felt about their current financial conditions compared with a year ago, and a 4.8% slide regarding their finances during the next 12 months. All of this is pointing to the failure of current fiscal and monetary stimulus, and this could well deteriorate further in the months ahead. Now, tell me again why you think the property market has turned positive. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.